Good morning and welcome to our update on the Amati AIM IHT service. I'm Colin Thompson, one of the sales team at Amati, and presenting today I'm joined by Paul Jourdan and Scott Mckenzie from the team. Against a backdrop where over a 3-year period AIM has lagged UK large and mid and small indices, it was great to see a number of pension providers as signatories to the Mansion House Accord, signalling perhaps a renewed focus on revitalising AIM, potentially a boost of 25 billion into UK assets, including AIM stocks by 2030. There are a lot of great companies on AIM, that's well known, trading at a very attractive valuations, and while net flows have been a persistent headwind for UK equity funds in general, the tone has changed recently. Sentiment suggests a potential shift towards the UK. Paul will start off by setting the scene in terms of market backdrop. Then Scott will present the positioning of the AIM portfolio and hand back to Paul for an outlook. We've left time at the end for Paul and Scott to answer any questions that you'd like their opinion on, so please enter them on the webinar page and we'll cover them following the presentation. With that, I'll hand over to Paul.
Thank you, Colin, and good morning to everyone joining us. Thanks for taking the time to listen. So quick update on the investment team here at Amati. As those of you who know us will know already, our colleague David Stevenson retired at the end of March, and our team was supplemented last year already with Gregor Patterson, who joined us with 25 years of experience of UK small cap and has been a fantastic addition to the team. So this is how we currently sit, and Gregor has taken over many of the sectors that David was covering before. I'm going to start off not by talking about this slide, but really just sort of diving straight into some of a quick update on what's interesting and relevant to an AIM IHT portfolio service at the moment. I was just looking back. We've had a pretty volatile 6 months since we last did one of these updates. The first quarter was pretty dreadful, and market got itself very depressed into the Trump tariff terror, as we like to call it, which kind of culminated towards the end of March, early April. And since then, we've seen really a very strong 3-month period, and it feels like the market's really changed gear significantly in the last 3 months. And I think to many of us who've lived through some long market downturns in the past, this feels like the market's reached a turning point. Of course, you never know that. There's no bell that rings at the bottom of the market. But it feels like the dynamics of the market have become much more positive. And a little illustration of that this morning, we've had one of the stocks in the portfolio with just a reasonably positive trading statement, was expected to be negative. It's gone up 24% this morning from a very low rating to just a modest rating. And that's indicative of a market that just feels heavily oversold and where sentiment's been very poor to some of these companies. On the legislation front, I think last time we spoke, we just had the slight shock of the November budget when really the AIM IHT benefits were reduced, and inheritance tax relief for AIM holdings was cut from 100% relief to 50% relief, and that's going to come in, I think, in April next year. The big question that's gone alongside that, really, and a lot of pushback to politicians has been, what about private companies? And what they appear to do is create a very non-level playing field, where all you have to do is make an investment in a private company, and you got 100% relief up to £1 million. So a limit's been imposed on that, whereas an AIM that didn't apply. I think a lot of discussion has gone on about this. There was, as all the advisors watching this will know, that there are services up there that will just put money into private companies that are designed to take very little risk, and those companies will get you 100% tax relief and hand you the money back, and they're designed to be able to get liquidity in and out, and so on and so on. I think there was pretty little awareness in Treasury really about those services 6 months ago, and also in HMRC. So there's an ongoing question really about what view is going to be taken of them, and what action will the government take. Obviously it's not for us to sort of speculate on what might happen, but I think one aspect that anybody looking at those services really needs to consider hard is how do they fare under the anti-avoidance legislation for tax, and I don't know the answer to that. I know there are discussions going on to look at it, and huge amount of lobbying going on about it. How that all comes out in the end, I don't know, but that's certainly something to think about. And I suppose one of the things we were saying 6 months ago that's very good about the budget and the moves that happened to AIM is that for the first time AIM was explicitly given a tax relief, whereas before that it was always slightly accidental. Last November, the Chancellor stood up and actually said, yes, we recognise AIM gets this tax relief. We want to make it more modest, but we also want to have it. So buried in there actually was I think quite a big endorsement of AIM. Clearly, everyone's asking the question: is that going to change again? I personally don't think it will. I think it would be such terrible policy making to mess around with it again. Having said that, nobody from the government's come out and said this is now permanent. But then we're in such a state of flux, really, in policy making that even if they said that, would it be credible? It seems that decisions are few decisions are set in stone. However, it would be very, very perverse to change this again, and I generally don't think it will be. Incidentally, Kemi Badenoch, leader of the opposition, who obviously who knows what happens at the next election, but she has come out and said that she would reverse the BPR changes. So they're definitely not going to reduce them any further if there's a change of government to the Conservatives next time. So this feels like it's good. Longer term, this turns into something of a positive, in that it feels like the whole regime of what benefits you get for holding AIM stocks should become a good deal more recognised and more stable going forward. So that said, lots of people always say, you shouldn't let the tax tail wag the dog. Is AIM fundamentally worth investing in? And this is a key question. So starting with just a very few quick slides here, which I'll then invite Scott to come in and tell you more about the portfolio and how we manage it and what's been happening. This is just the long-term view, the classic sort of UK smaller company effect, as analysed by a couple of professors from the London Business School over a long time, showing that you do get paid to buy small in general in stock markets, and that's been particularly true in the UK. And you can see here, even after such a torrid time for small caps, over this long period, there's a clear differentiation for buying small over in the long run. This is a quick analysis of some bear market drawdowns. So in recent years, small caps have fared quite a lot worse than large caps, and this does happen in the market. And in fact, it happened in the early 90s, shortly after the smaller companies effect. First paper was written in 1988. There was a long period when large caps outperformed. It didn't change the long term, however, and that didn't last for more than a few years. And that's what we've seen here, a few years of, if you like, contra trends in terms of large caps outperforming. I think Scott and I pretty firmly believe that the small cap trend is going to reassert itself probably fairly soon. This is looking more the shorter term, shorter medium term. What's happened to AIM? So this has been in the headlines a lot. AIM has badly underperformed even the kind of fully listed small cap and mid cap end of the market. And what's been going on here, and you can see particularly the 3-year returns are a million miles away from the mid cap returns. So there's two factors here that we need to consider. One is, of course, are all AIM companies rubbish, and this is just a kind of to do with the companies themselves, or are there other factors that are affecting companies that particularly companies on AIM rather than on mid cap? And there are, and we're going to come back to that. Or rather these other effects. So in terms of the quality of companies, I think AIM is a mixed bag. It's always been a mixed bag. There are some pretty poor companies that get onto the market, There's some very early stage companies that get into the market, and those are by definition are much riskier. But also there has been, and I think will continue to be, a significant chunk of stocks which are just really decent, solid, small companies, and in many cases, really decent growth companies. And those are the ones that we're really looking for. And we have particular characteristics that we look for in this portfolio to steer us slightly towards the more conservative end of the market. And those companies, there have been a few effects which have really hurt because of being on AIM, and obviously the budget last year, the big change, reversed what was a very positive liquidity dynamic on AIM, with some money coming in almost every day into AIM portfolio services. And if you like, in some ways, AIM was, because that's changed, AIM's been partly a victim of that in the past couple of years, where uncertainty crept in, and then the budget changed, and we've had all kinds of upheavals. Money's been flowing out of AIM. There's no longer a steady influx of liquidity all the time, and the markets had to find a new equilibrium. And that's really what went on in the first quarter. We've also seen this effect where some companies announced they're going to leave AIM just to list because they've been convinced that AIM doesn't have the same future that being fully listed does. I think Scott and I are really pretty convinced that in anything other than the short term, it doesn't make any difference at all, really, whether you're on AIM or on the full list. It's a bit of a pointless exercise, and we certainly encourage companies not to waste their time and money on doing that unless maybe they're over £1 billion plus, and there's very significant reasons for not doing that. Interestingly, the example we had the other day of Rosebank raising £1.4 billion from global institutions and really large global investors on AIM, really belies this fact that nobody can invest on AIM. There's this great, supposedly the great reluctance to do it. We just don't see that. And in any case, there's quite a high degree of fungibility of money between AIM and the full list. So if money goes into the mid cap, prices rise. That it's only a matter of time before that trickles down to ratings on AIM. So we have seen, I'd say, a 6-month quite severe distortion, and that's now beginning to unwind. And the pathway between those companies which are delisting on AIM and moving to full list are now finding that that there's becoming a sort of well trodden path for doing that, and companies are getting a bit smarter about how to do it. There's more to learn, and there's more there's more process to go through to make that a slightly smoother process. But some of the big negative effects we're seeing in Q1, and they're beginning to unwind now. The fund flows in the UK have still been negative, or they were still in April. This isn't the only picture. So fund flows are one thing, and we don't think fund flows have really turned positive yet, although I do think markets are self-feeding, and it's important to remember that. So if good performance carries on at the smaller end of UK small cap, that's going to attract money in the near term. But over and above this, there's the whole pension fund arena, where pension funds have been withdrawing capital from UK stock markets, full stop, large and small cap, for 20 years. That feels like that's being challenged now, and we did see one of the first instances where a large group of local authority pension funds put £1.4 billion into UK small and mid caps in May. I think that happened, and we've seen the effect of it. The impact has been pretty substantial. So we think there probably is more to come on that front, and that's what's beginning to change the dynamics in the market overall. This is just looking at the UK in comparison to other markets, and actually we can see that year to date this is emerging to be quite a positive story now, and the dynamic has changed. And then finally here we've got the alternative markets in the short term over 1 year still lagging. But actually, this picture is evolving quite rapidly, and the most oversold market, which was AIM, is now fairly rapidly. It feels to us fairly rapidly re-rating back upwards, as we've seen in that company I was talking about this morning, Volex, where we've seen a very sharp move just on a piece of mildly positive news. On the UK economy, there's lots. We could put up lots of slides here. The surveys are still mixed, but you can see here real disposable income is maybe the standout feature, And while we've got a big problem with government debt in the UK and a very ropey government balance sheet, and remember, a lot of the government debt is off balance sheet, so the debt is bigger than it looks. Offsetting that is the fact that consumers in the UK, households in the UK, have a very high proportion of savings, and the savings rate's been high for a long time. So household balance sheets are strong, and really that is underpinning the economy at the moment. And finally, on this section, the money supply, which is something we keep a pretty close eye on with the help of the Institute of International Monetary Research, who publish this data every month. You can see here that after a huge volatility between 2020, beginning of COVID, and really the end of, and 2024, where money supply was all over the place, and you can see the annual rate went below zero in 23, which is really what brought down inflation very sharply. It's now normalized right back to 5%, and 5% is kind of the sweet spot for UK money supply growth. And actually, even though a lot of other figures might look quite scary, this one tends to be incredibly strong in terms of determining outcomes for markets and inflation and the economy overall. So actually, we take a good level of comfort from this normalization. With that, I'm going to hand over to Scott to talk in more detail about the portfolio.
Thank you, Paul. Just to kick off, we'll give you a quick summary of where we are today with the AIM portfolio service. The value of the assets is about 45 million, so we're a relatively small player within the overall AIM IHT market, which some of the estimates reckon is about £6 billion or thereabouts. So about 10% of AIM roughly is invested in the IHT portfolio service market. We're a relatively small player within that. We'll come on and talk about the portfolio in a moment. We have 28 holdings, and we'll discuss how we select those as we go through today's presentation. It's important to note that we tend not to invest in the very smallest AIM companies. Paul made reference earlier to some of the lower quality businesses, which tend to be quite small. The weighted average market value of the businesses that we own within the service is 580 million. So these are all very healthy, well-established companies by and large. And obviously within Amati as a whole, we have our main UK listed smaller companies fund as well, which is approximately £200 million, and it itself also has a very healthy exposure to AIM at roughly 50% of the assets. So AIM is still very much a core part of what we do here at Amati. And in terms of the analysis of the portfolio that I referred to a moment ago, the businesses which are valued at less than 100 million market value are a very small part of the portfolio, about 4%. So we're typically not looking for the tiniest companies within the AIM market. We prefer to focus on what we regard as a sweet spot, which really is shown in the grey, black and brown pies. So the vast majority of the portfolio today ranges from 100 million to £1 billion in market value, and that's really where we see the core of the portfolio and indeed our own research efforts taking place. So liquidity has been important in these challenging times, and we have very limited exposure to the smallest businesses on AIM. In terms of the service itself, we've been going for just over 10 years now, since 2014. And we had many years of very good performance. It's fair to say the last few years have been quite challenging, not only for AIM, but for the portfolio in general. And you can see over the 3 years, both the portfolio and AIM have delivered disappointing returns. And the last year has also been quite challenging, particularly the end of 2024 and the beginning of 2025. But it's pleasing to note we're now on a definite upward trend, and over the recent months, the portfolio has enjoyed a very strong recovery as AIM has begun to recover itself. And looking at the month that we're in of June, again, we would hope to report some quite strong improvement in performance for the month of June, such that in the first 6 months of the year, we should be well ahead of the AIM market, which itself is also beginning to recover. So we do have some work to do to improve the medium-term performance here, but the shorter-term omens are really positive. And as Paul referred to earlier, we do genuinely think we're seeing a very significant turn now in the fortunes of the AIM market in general. In terms of what AIM comprises of these days, this attracts a lot of attention. we cannot deny it's becoming a smaller universe. And over the history of AIM, it's just celebrated its 30th anniversary, the AIM market. So over those 30 years, we saw a real boom in the 2000s up until the global financial crisis, with a number of companies peaked at over 1,600. As we sit here today, we have 650 companies on AIM, so the numbers have gone down steadily over a number of years, and that is continuing. We're not seeing many new companies coming to AIM of any substance. We've only had one meaningful IPO in the current year, an accountancy firm called MHA. But beyond that, there are very few meaningful IPOs happening on AIM. As Paul suggested a moment ago, we are, however, still seeing companies being able to raise money in AIM. So, there is an appetite for good companies raising money, but we're not seeing very many new companies enter the AIM market at this moment in time. And clearly we're losing companies both to the main list and to takeovers. So we're dealing with a smaller universe than we had. The market value of AIM is about 65 billion today. So it's a relatively small specialist market. On the right-hand side, we analyze those companies by their market value. And the vast majority of the 658 companies are very small. Most of them are below 100 million in market value. So what we've done here is just look at the companies which we regard as our universe for this service, and those are companies which are typically above 100 million in market value. And of those, we've ringed them in red on the slide, and we probably have about 150, 160 companies that we believe we can select from for this service, and from that we have 28 companies. So as a deliberately focused portfolio, we typically will have between 25 and 30 companies in this service, and we don't intend really to have a great deal more than that because of the size of the universe. So it's a smaller universe, but we can still find some very good liquid companies within it. We can't ignore the fact that companies have been leaving AIM, and since the budget, this has escalated, if anything, due to some of the uncertainty about the IHT rules. And there are companies in the service who have already left, and some companies which have indicated that they may. And this is really not something we want to see, for investors in the AIM IHT service. Clearly, we don't want to be losing good companies to the main market. And we were disappointed to see both Gamma and Brooks Macdonald leave, and unfortunately, they no longer qualify for BPR being main listed, and therefore the service has to sell those companies when they leave. And that's posing challenges for a lot of companies who are trying to make this transition. We have 3 other companies within the current portfolio, which are shown on the slide: Ashtead Technology, GB Group, and Mortgage Advice. And we're engaging with these companies because ultimately we don't really want good companies to be leaving AIM. And sometimes they're not always getting the best advice, in our opinion. So we're engaging quite heavily with those businesses that are considering this. And in many cases, companies are confirming that they will remain committed to AIM, but it's nevertheless, something in the past 6 months that has become more of an issue. And really, we don't want to be in a position where we have to sell good businesses, from this portfolio. So we will remain, in touch with the businesses shown in the slide. The good news is they're all very strong companies, but they have to, if they're moving to the main list, be ensured of a wider audience. In the case of Gamma, it's a £1 billion market cap company, a very substantial business which larger funds can happily buy. But the smaller businesses on AIM have to be careful that they don't get lost if they move to the main list. So the companies who have indicated this, you do have some considerations to make, and there is a big shareholder transition which goes on. And in the case of companies such as Ashtead Tech and GB, it is momentarily depressing the valuation of those businesses because of this transition period. So we will continue to engage with companies. It's our preference that they remain on AIM unless they have a very good reason to move to the main list. So that's something that as a team we will be actively engaging with in the months ahead. Clearly, there have been companies which have been leaving AIM, but I'm pleased to report that we've had no shortage of new ideas for the service. So even as we are losing companies, we're also bringing in new ideas, from the subs bench into the portfolio. And over the past 12 months, we've had, a total of 7 new investments in the portfolio. So although the AIM market itself, has been reducing, there are no shortage of great businesses left on AIM, and we've given you examples of a number of companies that the service has invested in more recently, and those range from the very largest company on AIM, Jet2. It's a £4 billion company, a very liquid, respected business, to more smaller businesses such as Mercy and Netcall, which are smaller market caps. So we have 7 new investments, all of which have made a meaningful positions within the portfolio. In terms of how we filter the companies, I'll come on and talk about the various types of companies that we own in a moment, but we do take a lot of account of quality and risk within the selections. So we're not buying companies which are not already well established. These are typically companies with strong track records already. And we use the Canaccord Quest database to help us in that initial analysis, and we're shown here on the slide the Quest risk rating, which we think is a really important part of how we assess liquidity and risk within these AIM businesses. And in each case, our new additions have got very, very healthy scores out of 100. They're typically in the top quartile. So we're fairly happy that we can still find great businesses to buy for this service, and hopefully the examples shown on the slide here, are testament to that. And we have a wide array of different types of sectors as well, from Jet2 in the travel business, a clear market leader in the UK package holiday business with an outstanding track record. More topically recently has been the increase in defence spending that we're now all seeing across Europe, and our investment in Cohort has been a major beneficiary of that trend, and that's a business which goes from strength to strength, and it came into the portfolio towards the end of last year. And in the asset management world, we've recently invested in Impacts, which has really fallen out of favour quite considerably in recent times. It's been at the forefront of sustainable investing, which is very much out of fashion at the moment. So we've taken the opportunity to buy a business on what we regard as a very distressed valuation there. And similarly, Mercia is potentially a beneficiary from some of the Mansion House reforms that Paul referred to earlier. It's got a significant private equity business and a venture cap business, which we think is ideally placed to work with pension funds going forward. So a real wide array of different businesses, Netcall being a technology software provider, mainly to the public sector and to the finance segment. And then more esoterically, MP Evans, which is a palm oil business, a very strong record of substantial dividend growth and cash flows. So really no shortage of ideas from the team to replace the companies that we are unfortunately losing, and some of these businesses have already made some very strong contributions to the portfolio. In terms of how we structure the portfolio, there are 3 main types of companies that we look for once we've done the initial screening, and those are shown on the slide here. Majority of companies that are on AIM tend to have very significant management participation, and in some cases family ownership as well. And we've given a few examples of some of our key holdings here who fit that bill. And we do like co-investing with companies and with their management and their families. Generally, there's an alignment of interests, and that's one of the great strengths of AIM, that many of the companies that we invest in have that alignment with their investors through the management or the family being significant shareholders themselves. So the examples on the slide there, Gately was the first legal firm to come to the London market 10 years ago now, and it still retains about 50% of its ownership within its staff and its directors. Young's has been going for almost 200 years now. Again, a famous name in brewing. Now, a pure play pub company. Again, a very strong, well invested business with a long track record of dividends. So very much keen to be co-investing with families and managers. Technology has been quite a tricky sector in recent years on AIM. There have been a fair share of difficult companies which have, where the bubbles have burst. So we do have to be careful in technology in terms of the quality of the businesses that we invest in. We deliberately call this category established technology, because we really only want to invest in companies which have got strong track records already, which have significant cash flow, strong balance sheets, and are not, as my colleague would paraphrase, science projects. These are companies which are already very strongly established in their markets with really good growth prospects. So both of these companies here, GB Group and Boku, come into the portfolio in the last 18 months. We're quite excited about the prospects, certainly for Boku and its payments business. It's a global business with a huge potential market to come. GB Group is more of a turnaround situation. It's a company that we've owned in the past in our funds, and it hit some troubles, in the last 3 or 4 years, made a badly timed acquisition in the US. So it's more on the recovery path now. Management has changed, and that's a company which we believe, has got quite a lot of recovery potential from here. And finally, the durable defensive category, as the name suggests, these are very steady businesses with really strong cash foundations. In each case, they tend to pay strong and growing dividends. So they provide the investors within the service with a foundation of income, which is quite important. So these are companies which we believe will be non-cyclical and will compound their dividends over time and hopefully give us a growth kicker as well. And I mentioned MP Evans a moment ago. It's got an outstanding dividend track record over many years. Renew has had some issues in the rail sector in the current year, so that's one where we're yet to see the best in terms of the capital performance, but we do think it's outstandingly well placed in the long run in terms of exposure to infrastructure in the UK. And finally, property franchise, as the name suggests, is a franchised estate agent and mortgage advice business, and that's now beginning to attract quite a lot of attention. It did a merger a couple of years ago with Martins, and it's now becoming a larger business and therefore more attractive to a wider audience. So that hopefully gives a flavour of the way that we construct the portfolio, with the emphasis being on high quality businesses that pay dividends to our investors. In terms of the style of the portfolio, the main thing to kind of highlight here is the bias towards growth and quality factors. So that's hopefully consistent with what we've just discussed in terms of the quality of the businesses. They tend to have high profit margins and high returns on capital, as shown in the grey bars. And we want companies which can grow their dividends and their earnings on a consistent basis. That really is the core of what we're trying to do with the portfolio. And in some cases, we may also get a dividend yield into the bargain. So the dividend growth is as important as the earnings growth for this portfolio, so that we can give our investors a real solid foundation of growing income as well as capital growth. So growth, yield and quality combine to make up the majority of the portfolio here. Paul made reference to the valuation issues in small cap earlier in his discussion, and what we've done here is just give you some comparatives for the portfolio. The portfolio is shown on the far left column as at the end of May. We've compared it to the Canaccord Quest UK smaller companies database, just as a rough benchmark for the smaller company market in general. And then on the final right hand column, we looked at the AIM IHT portfolio as it was, when markets were somewhat rosier 3 years ago. And we can see there's been an enormous derating of the portfolio during that 3-year period, whichever measure one cares to analyse, whether it's the price earnings ratio or the EV to sales or the free cash flow yield. All of these measures are now materially more attractive than they have been for a number of years. And in terms of the portfolio compared to the Quest benchmark, we can see here that we've got much stronger cash flow, much better debt ratios, and much higher profit margins. So we do genuinely believe that we have a portfolio of great quality here that is extremely undervalued. And that is really absolutely key to what we believe will be better returns in the future. So hopefully that gives everyone a flavour of the portfolio as it stands today, and how excited we are about the prospects going forward. And with that, I will pass you back to Paul for some concluding thoughts.
Great, thank you, Scott. This is really just a few thoughts concerning the outlook for the market. I've already touched on the general thoughts here. Interest rates obviously are a big factor in determining the direction of travel in markets and the ease of travel. Clearly they've been coming down. They haven't come down as far as was predicted a couple of years ago or as fast, and that's to do with further disruptions to just global affairs and uncertainty over tariffs. It's probably the case that the rates are going to fall a little bit further. I don't think we're expecting to see any dramatic falls from here. We're certainly not banking on any inflation has been probably a little bit higher than was expected, and given the money supply figures we saw, it doesn't look like inflation's going to suddenly fall away in the UK. It needs careful handling, but feels like there's scope for a little bit more in the way of rate cuts. But then it's probably going to rates will probably stay in and around this kind of area for some time. Clearly, one thing we keep pay a lot of attention to is the long bonds, the 10-year bonds, where they were, if one looks at any but the high pressure points in the market over the last 6 months, maybe early January, around April, the real thing that was stressing investors was the long bonds rates were rising, and there's not a lot of tolerance for that, either in the UK or in the US and many other countries. So, but those have eased quite a bit in the last few weeks, which is again encouraging. Echoing the point Scott was making about market valuations, here you got PEs, and you can see the UK market as a whole. This is just saying FTSE 100, FTSE 250, very significantly lower PEs than we're seeing in other international markets. This is, of course, a crude measure because you're not measuring like-for-like companies, but it is indicative of the overall state of affairs. Quite interesting on the right, the stock market to GDP ratio being very low in the UK. I think we and many other investors have been trying to point out to everyone we can get to speak to in terms of policy making that you need to pay more attention to UK public markets. This decline is really not good in the long run for the UK. And one might say, well, isn't it fine if we just all invest in the US instead? But actually, there are some big problems with that. And President Trump has announced some of those problems in the last few months by floating the idea, well, why don't we just tax foreign investors investing in our stock market? We do need a stronger domestic UK market, and we lose that at our peril. And so hence why more policy attention now is being paid to addressing that. And that would be, again, positive for the UK market. This was quite an interesting chart that came out in April looking at US equity allocation shifts and sentiment expectations of how allocation is going to move. And as you can see here, Eurozone and UK were massive beneficiaries in sentiment terms during the Trump tariff chaos, and the expectations were that US equity allocations were going to fall. I think there's evidence to suggest this is going to happen. These things never happen very fast, but we are seeing evidence that this is the direction of travel now for a while to come. This again is looking at the smaller companies' effect, and so occasionally small companies go to parity with larger ones, or sometimes even premiums. At the moment, they're at their usual discount to large and small mid caps. So again, that's a sort of that's a positive backdrop for investing at this end of the market. And I won't read all of these out, but you'll have got the sense by now that we think that the market outlook is a good deal more positive than it has been for UK small cap. And yeah, we're looking forward to the second half, actually, to seeing some of this play out. And with that, I think we should see if there's any questions.
Great stuff. Thanks very much, Paul. First question, how does the Mansion House Compact benefit AIM shares? It seems to be more about private assets.
Yeah, maybe I should come in on that. So, I mean, the Mansion House Compact has some things which we do really scratch our heads about. And in particular, why is there this sort of obsession with private assets when actually there's a huge amount of capital in investing in private companies in the UK and everywhere else? And that I saw a bit of analysis which was saying there's something like $1.2 trillion of dry powder in private equity funds currently. So there is no shortage of demand for private assets. But and the other bizarre thing about it is that it seems okay if half of those private assets are invested in are overseas, which also seems to me strange. But where this is a positive for AIM is that included in the definition of private assets are AIM shares, and that this it's also why AIM qualifies for BPR, why it qualifies for VC and EIS. It's because AIM is not a regulated, with a capital R, regulated market. And the legislation is built up around regulated markets equaling being listed. Whereas if you're not a regulated market, you can benefit from the status as being a private asset. And hence, if you sit back and think about it, if you're a pension fund, what kind of assets do you want to, and you want to comply with the Mansion House Compact, what kind of assets are you going to look at? Well, surely AIM shares are going to be up there with, the palatable assets that you could buy, and particularly given how compelling the valuations are, how oversold many of these companies are. We are expecting more money to come in from pension funds into the AIM market because of that.
Thank you. Scott mentioned that AIM's losing companies to the main list and to takeovers with not much replacing them. What can be done about attracting more businesses to list on AIM?
Yeah, it's a tricky one, really. I made reference to the fact that we've only had one meaningful IPO in the current year, an accounting company called MHA, which has the Baker Tilly brand as well as part of its business. And actually, it's got off to a pretty good start. The shares are up over 20% since they were listed. It's about a 300 million market cap. So we don't believe that it's through lack of appetite. Paul made reference to the Rosebank fundraising, which is north of £1 billion. In our smaller companies fund last year, we took part in Greatland Gold, which raised $350 million on AIM. So where there are good companies wishing to raise money, then there is definitely an audience for them on AIM. The problem we have is, as the question suggests, is how do we get new companies onto AIM? And that is definitely more challenging, and that requires a lot of kind of joined up thinking between the LSE, between the Treasury, between the government, and there's more companies staying private for longer now as well. So there's no magic answer to this, really. But hopefully, as AIM begins to recover, as people see that the market is is not dead and it's actually reviving somewhat, that will encourage more companies to think about coming to AIM. Mm-hmm. And there's also been an issue in recent years where people think the grass is greener on the other side. Tech companies, for example, have been encouraged to list on NASDAQ, and we think that's potentially quite an error for small to medium-sized companies because they get lost when they go to NASDAQ. So it's really a question of everyone working together, who's got an interest in UK capital markets to encourage small and exciting companies to come back to AIM. And we're not there yet, but as I say, if AIM performance begins to improve, then hopefully that problem begins to eradicate.
Great,
thank you. Paul, do you have anything to add?
Just one thought to add on that, which I was speaking to somebody on the sell side recently I'm putting this point to them, and they just commented that they think their pipeline of companies that want to come to the AIM market is better now than it's been for many years. And obviously that's something that will play out over 1 to 3 years. It's not short term, it's the longer term pipeline building. That's easy to say. We've got to turn that into actual evidence. And obviously, it's also true that you're not going to start to see lots of IPOs unless the market re-rates somewhat, because the prices are just too low to attract companies to want to. They have to float at a discount to current valuations, and so it's pretty off-putting if the market's already very cheap. And the other factor here is that AIM is lacking in liquidity at the moment. And although Rosebank was an interesting exception to that, raising over £1 billion, astonishing. But in general, the normal buyers of AIM IPOs are not that flush with liquidity, with certain exceptions. So unless you're going to tap into one of the exceptions, it's quite hard to float right now. That would change if the liquidity dynamics, which I was talking about earlier, begin to go the other way, and there's more of a flow of money coming back into the market, and then we would start to see IPOs switching on again.
Great. Thanks very much, Paul. So that's all for the moment. If any other questions come to mind, please get in touch and we can put them to the investment team and get back to you. Thanks very much for joining us, for your support and for your interest in the sector. And as I mentioned before, please get in touch. The sales team are now on the on the slide there, and we can also be found, contact details can also be found on our website. So until the next time, thank you for joining us, and goodbye for now. Goodbye.